My name is Blaire, and today I will present to you my analysis on Foot Locker Inc. Foot Locker is one of the leading global retailers of athletically inspired shoes and apparel headquartered in New York that actively adopts a banner differentiation strategy. The company's business model remains relatively focused, as the athletic store segment remains the key driver of sales. Geographically, most of the operations locate within the US, but it has significant global presence, especially in Germany. As you can see from the stock performance chart, its price has grown by almost 167% over the last 10 years. Analyzing its relative wealth chart, we see that between 2000 and 2006, Foot Locker's CFROI was consistently above its cost of capital, signifying successful generation of shareholder value. However, due to weak consumer spending as a result of financial crisis, CFROI level plunged. But the company reacted by reducing its capex, inventory, and operating expenses to improve cash flows, as shown by the negative asset growth in 2009. Foot Locker thus emerged from the recession with a strong financial position, as CFROI level has soon risen above the cost of capital from 2011, indicating the strength of its fiscal management. Changes in CFROI is due to its three drivers: sales, margins, and turns. From 2001, the company adopted an aggressive growth strategy. The acquisition of Foot Action and stores in Ireland explains its tremendous sales and asset growth in 2004. However, its CFROI levels were slowly declining in the same period due to decreasing halt inflation-adjusted asset turns. Due to the challenging macroeconomic environment shifting consumer tastes, its sales growth slowed down in 2007. CFROI therefore dropped below the cost of capital. Emerging from its financial crisis, Foot Locker started to adopt a growth strategy again with the acquisition of Germany's Runners Point Group in 2013. CFROI gradually rises above the cost of capital. Comparing Foot Locker's operational performance to its peers, we see that its management does possess the ability to grow the firm, as the CFROI and operating margin are both above the industry median. Asset turn falls short of industry median, indicating that management should focus on efficient utilization of capital to generate economic wealth for shareholders. Looking at historical valuation, we see that the hold and took prices have been generally above market prices since 2012, showing that the stock is undervalued. Although fate in the hold valuation methodology and market implied model forecast an end to Foot Locker's recovery in the long term, stock prospects remain positive, at least in the short and medium term. Therefore, given the company's rising CFROI, high growth potential, track record of strong fiscal management, I conclude that Foot Locker is currently undervalued and recommend an outperform rating.